Hope you all are having a great day today. Today we're going to be talking about why you might not want to buy an ETF or a diversified mutual fund. Let's talk about some of the negatives that exist when you buy a mutual fund or ETF to diversify your assets. Now, the number one reason why negative that I see when it comes down to buying one of these ETFs is that you don't have much control over what stocks are in the portfolio. If you buy the ETF, it's up to the fund manager to decide which stocks are in the portfolio. In a way, you might like that because you might say, hey, I don't really know about any of these stocks, so I don't want to be in charge of it. I just want to be diversified, and that's fine. But there is a negative when it comes down to this. As an example, if you're buying like a tech ETF, let's say that one of those stocks just goes up enormously, like Tesla. As a result, Tesla might have a greater share of that ETF than you might want, and as a result, it might expose you to more of that stock than you prefer. As an example, Tesla has gone up to the moon. It's worth a fortune, and it is a big part of the QQQ now. It's actually one reason why I don't think I would want to buy QQQ at this time, is because Tesla has really become too big a part of the technology scene, and if you really focus on what's going on, it doesn't seem like Tesla is really worth what it's worth. Isn't Tesla worth like $300 billion now?
Which one, Tesla?
Tesla, how much is Tesla worth? Like 300 billion or something like that?
It should be worth a few trillion.
Now, that's one reason why I wouldn't want to really buy like a QQQ, is because Tesla's, by nature of being such a large company, is not going to be a large part of QQQ. So if Tesla goes down 20-30%, it's really going to drag down your tech ETF, and that may happen despite the fact you think, hey, I want to be diversified. Now, number two, some people have moral issues about certain stocks. Maybe you don't like tobacco companies, alcohol companies, or you don't like gaming, casinos or stuff like that. So if you buy an ETF, sometimes you're exposed to you're an owner in companies, maybe you don't want to invest in them. So that's just something to consider. When you buy an ETF, you don't have as much control over it as if you buy the stocks. And another negative when it comes down to these diversified ETFs is that you have to pay an annual fee for owning them. Now, some companies charge you very, very little, like Vanguard, but if you actually own these stocks outright, like if you own Microsoft or Apple, there's no yearly fee for owning them. But if you own it through an ETF or something like that, then you're going to have to pay an annual fee for the privilege of owning it through the fund, because in a way you don't really own the stocks directly. You own the fund which owns the stocks, and as a result you're going to have to pay for the fee of owning these stocks, and that's just something to keep in mind. It means that there's a higher expense in terms of owning these stocks than you would some other approach. So that's something to keep in mind, is that there's a higher cost of ownership than if you own it other ways. Another problem, it has to do with capital gains. If you own these diversified ETFs, oftentimes sometimes the fund owner will sell the stocks, but you will actually be the one who pays the tax burden. So even though you didn't do anything, you may actually find that's not very tax efficient. You may end up having a tax bill even though you didn't do anything. So that, for some people, don't like that, and that's something to keep in mind, because if you own just, say, Microsoft or Apple or Amazon, and you don't sell it, you don't pay any tax. But if you were to own it through an ETF, you can't really know for sure what the fund owner will do, because sometimes for whatever reason they do sell the stock at a profit and the tax gets passed along to you. Another thing to consider and keep in mind is that owning these diversified passive ETFs, it does not eliminate risk. Some people say, oh well, there's no risk involved because I'm diversified. That's actually not true completely. The truth is that some ETFs are a lot more concentrated than you may think. Like, as an example, if one of the stocks were to go completely out of business, it may have a bigger impact on the portfolio than you had imagined. Maybe that one stock is 10% of the entire portfolio. As a result, if that one stock goes completely out of business and goes wiped out, maybe the ETF goes down 10%, and maybe that's not something you had anticipated. So something to keep in mind. Just because it's diversified does not remove the issue of risk. There is still the issue of risk. It's still inherent in the process of owning an ETF. And some people, they just think, well, because it's diversified, it means I'm completely protected, and no matter what happens, nothing is going to happen. Well, the truth is, if, as an example, if you're in a super bubble and things go down 90%, well, you're still going to go down 90%. I mean, as an example, a lot of people, they do love the tech stocks because I think they're interesting. So if you're heavy exposure to NASDAQ, if you are in a bubble and things go down 90% like they did in 2000, from 2000 to 2002, I believe that NASDAQ went down 90%. So if you have a heavy reliance or focus on NASDAQ, you're going to get hit and creamed pretty dramatically. So it's something to keep in mind that it might not, whatever you have, it might not be as diversified as you think. So that's just something to keep in mind. Consider the level of risk involved, and there's no such thing as zero risk. There's risk in everything, actually. If you own just money in the bank account, there's risk of inflation. So that's something to always keep in mind. And I hope that I earned your like. Click a like on it, turn that like blue, and subscribe, and we'll talk about some more investment ideas in the next video. Thanks.